Let's look at an example of preparing the stockholders' equity section of the balance sheet. Turner Corporation has two classes of stock authorized: 6% $10 par preferred and $1 par value common. The following transactions affect stockholders' equity during its first year of operations. On January 2nd, they issued 10,000 shares of common stock for $20 per share. On February 6th, they issued 1,000 shares of 6% preferred stock for $13 per share. On September 10th, they purchased 2,000 shares of their own common stock for $40 per share. And on December 15th, they resell 1,000 shares of treasury stock at $50 per share. In its first year of operations, Turner Corporation has a net income of $20,000 and pays dividends at the end of the year of $9,000, or $1 per share, on all common shares outstanding and $600 on all preferred shares outstanding. We're going to prepare the stockholders' equity section of the balance sheet for Turner Corporation as of December 31st. So let's go ahead and start with the statement of stockholders' equity. What we're going to do is we are going to look through each of these transactions and look at what the journal entry looks like and how that moves on to the statement of stockholders' equity. So on January 2nd, they issued 10,000 shares of common stock for $20 per share. This looks like this: issued common stock, and it's going to look like this. The cash is going to be for the amount per share, but the common stock is for the par value, and then the additional paid-in capital is for the difference. So we're going to put $10,000 under the issued common stock under common stock, and the additional paid-in capital is going to have $190,000 in their column. Next up, they issued 1,000 shares of 6% preferred stock for $13 per share. We're going to recognize the cash for the amount that we got. The preferred stock will be recorded at par value, and the additional paid-in capital will be the difference. So, under the preferred stock column, we'll have $10,000, and the additional paid-in capital column will have $3,000. On September 10th, they purchased 2,000 shares of their own common stock for $40 per share. So we're going to recognize the treasury stock, the 2,000 shares times $40 per share, or $80,000. And we're going to recognize cash. Here's what that's going to look like on our statement of stockholders' equity. Remember, treasury stock is a contra equity account, so it reduces our stockholders' equity. And on the statement of stockholders' equity, we're going to put that down as a negative number. And they resell 1,000 shares of that treasury stock at $50 per share. So let's keep in mind that that's more than they repurchased it at. So the treasury stock itself is $40,000 worth, and the remainder is the additional paid-in capital. So the treasury stock will have an increase there of $40,000, and then the additional paid-in capital will be $10,000. In the first year of operations, they have a net income of $20,000. We're going to put that right in there under retained earnings. Also, they paid out dividends at the end of the year, $9,000, $1 per share on all common shares outstanding, and $600 on all preferred shares outstanding. That's what this is going to look like. $9,600 is a negative under the retained earnings for those dividends. So what you're going to do is you're going to total up each column and total up the total stockholders' equity. We're going to use that information next to move it and put it onto the balance sheet. So the preferred stock at a $10 par value is $10,000. Common stock at a $1 par value, $10,000. Additional paid-in capital is $203,000. We're going to add all those up for our total paid-in capital of $223,000. Next up, retained earnings. We're going to put that in. That's $10,400. And treasury stock, there's still 1,000 shares outstanding at $40,000. The total stockholders' equity will be the total paid-in capital plus the retained earnings minus the treasury stock, bringing us to a total of $193,400.